In just 4 days, silver lost 35% of its value. This was not a market correction. It was not the result of bad economic data. It was something deliberate, calculated, and executed behind the scenes of the global financial system. While millions of investors watched their profits evaporate in panic, a select group of institutions did exactly the opposite. They were buying physical silver in industrial quantities. The collapse began on a Monday, during the Asian overnight session. The timing was no coincidence. It was the moment of lowest market liquidity, when few traders were awake to react. Suddenly, hundreds of thousands of silver futures contracts were dumped onto the market. The price plunged vertically. Within minutes, stop-loss orders were triggered in a cascade, forcing thousands of investors to sell at the worst possible moment. The market entered a technical collapse. But here's what makes no sense. While the price was sinking in paper contracts, something bizarre was happening in the COMEX warehouses, the New York Metals Exchange. Massive quantities of physical silver were being withdrawn. This was not panic selling. It was silent accumulation. Someone was using the engineered crash to buy real metal at artificially low prices. The official numbers reveal a brutal contradiction. In the futures market, known as the paper market, there are contracts representing billions of ounces of silver. But in the registered vaults, those available for immediate physical delivery, only 200 million ounces remain. This means that if just 5% of contracts demand real delivery of the metal, the entire system collapses. There is not enough silver. And the institutions know this. For decades, central banks and large financial institutions have controlled the price of precious metals through this paper market. They sell futures contracts in gigantic volumes without owning the corresponding physical metal. It is a sophisticated way to create artificial supply. When they want to push prices down, they dump thousands of contracts onto the market simultaneously. The price falls instantly, regardless of the real supply and demand of the physical metal. This manipulation is not a conspiracy theory. In 2012, UBS was fined for manipulating the silver market. In 2014, it was Barclays' turn. In 2018, Deutsche Bank, HSBC, and Scotiabank paid multi-billion-dollar settlements after investigations proved coordination to suppress precious metals prices. The system is rigged, but it continues to operate. What makes this crash different is the global context. Industrial demand for silver is exploding. Solar panels need silver for conductivity. Electric vehicles use 3 times more silver than conventional cars. 5G infrastructure depends on components containing silver. Artificial intelligence and data centers consume silver in advanced circuits. All of these industries are growing exponentially, creating unprecedented demand pressure. At the same time, supply is structurally limited. 70% of the world's silver comes as a byproduct of mining other metals, mainly lead, zinc, and copper. This means that even with higher prices, silver production does not increase quickly because it depends on the economic viability of those other ores. There are not enough pure silver mines to compensate for this limitation. Meanwhile, registered stocks at COMEX are at their lowest levels in the last decade. In 2015, there were more than 800 million ounces available. Today, that number has fallen to less than a quarter of that. The trajectory is clear and frightening: less and less physical silver available, while paper contracts grow without limit. It is a ticking time bomb ready to detonate at any moment. The situation becomes even more interesting when we analyze who is buying. Reports indicate intense activity from sovereign funds and central banks, especially from Asia and the Middle East. These institutions do not speculate in the short term. They accumulate real assets amid the global process of de-dollarization and changes in the international monetary system. If you are enjoying this explanation, do not forget to subscribe to the channel and like the video. Leave in the comments which city or country you are watching from, because what I will reveal in the next segments will change the way you see precious metals. The manipulation of silver prices does not happen by accident. There is a strategic reason behind this deliberate suppression, and it is directly linked to control of the global financial system. When the price of silver spikes, it signals something far more dangerous to financial institutions: loss of confidence in fiat currencies and a flight into real assets. During the 2008 financial crisis, silver jumped from $10 to $50 per ounce in less than 3 years. The same happened in 2020, when the pandemic triggered unprecedented monetary printing. Every time the financial system comes under stress, investors rush to precious metals for protection. And every time, the same institutions that caused the crises intervene to artificially push those prices down. The mechanism is sophisticated but brutal. It works like this: large bullion banks, those that trade precious metals, have privileged access to the futures market. They can sell thousands of contracts instantly, contracts that represent tons of silver they do not even own. This massive selling creates artificial panic. Retail investors see the price falling and automatically trigger their stop-loss orders. This generates more selling, which generates further declines, creating a devastating domino effect. The timing of these attacks is always the same: the Asian overnight session or the European afternoon, when liquidity is low. Fewer participants in the market means less capital is needed to move the price dramatically. It is like pushing a car, much easier when it is stopped than when it is moving. The institutions know exactly when and how to strike to maximize the impact. But there is another crucial element in this strategy. While they crush the price on paper, they buy the physical metal. It seems contradictory, but it makes perfect sense. By creating panic in the futures market, they force miners and small investors to sell physical silver at low prices. It is a silent transfer of real wealth from the uninformed to the well-positioned. The data confirms this unequivocally. During the recent crash, while futures contracts were being sold by the thousands, physical withdrawals from COMEX reached record levels. In a single week, more than 20 million ounces left the registered vaults. This is not panic market behavior. It is strategic accumulation disguised as chaos. The situation becomes even more revealing when we analyze the delivery history. Less than 3% of silver futures contracts result in real physical delivery. Most are settled in cash before expiration. This allows the paper market to operate with extreme leverage, creating a quantity of virtual silver that does not physically exist. It is legalized fraud through financial complexity. The problem is that this structure is reaching its limit. Industrial demand cannot be fooled with paper contracts. Solar panel factories need real silver. Electric vehicle manufacturers need real silver. Data centers need real silver. And this demand is growing exponentially while production remains stagnant. In 2024, industrial demand consumed more silver than was produced by the mines. The deficit was covered by recycling and accumulated inventories. But inventories are not infinite. Every year that passes with a structural deficit, less physical silver remains available. It is simple math. If you consume more than you produce, eventually you run out. Projections indicate that global silver inventories could be depleted within a decade. When that happens, there will be no paper manipulation capable of hiding the real scarcity. The price will have to reflect the physical reality of the metal, not financial fiction. And that is exactly why institutions are buying now. They know time is running out. They know repricing is inevitable. The question is not if it will happen, but exactly when. And more importantly, who will be positioned correctly when the market turns? There are precedents that show what happens when the paper market loses connection with physical reality. In March of 2022, the nickel market in London suffered a total collapse. A trader, forced to deliver metal he did not own, saw losses explode to 8 billion. The exchange suspended trading and canceled trades to prevent systemic failure. It was a warning: when paper meets physical reality, paper always loses. What is happening with silver right now is not just another market cycle. It is the beginning of a structural shift that will redefine how real assets are priced in the global financial system. And the signs are everywhere for those who know where to look. Central banks around the world are diversifying reserves like never before. Since 2022, after sanctions froze $300 billion of Russian reserves, countries began seriously questioning the safety of keeping all reserves in dollars or U.S. treasuries. The response has been clear: buy physical assets that cannot be frozen, blocked, or devalued through monetary printing. China does not officially disclose its silver purchases, but import data tells the story. In 2024, Chinese silver imports reached record levels, exceeding 10,000 metric tons. That represents more than 30% of global annual production. And they are not buying to speculate. They are buying because they need it for technological infrastructure and solar energy, strategic sectors for future economic dominance. India, the world's second-largest consumer, maintains strong demand despite any price volatility. Indian culture has treated silver as a store of value for millennia. When the price falls, they buy more. When it rises, they keep buying. This structural demand does not disappear with short-term manipulation. Meanwhile, in the West, investment funds are beginning to notice the discrepancy. Large managers such as Sprott and First Majestic are publicly warning about the disconnect between paper prices and physical reality. Some funds are already demanding physical audits of inventories before investing in silver ETFs. Distrust is growing. The ETF market reveals increasing tension. The world's largest silver ETF, SLV, must maintain physical backing corresponding to its shares. When investors buy shares in volume, the fund must purchase physical silver in the market. During the 2021 movement, when retail investors attempted to coordinate massive purchases, the fund had enormous difficulty acquiring enough metal. Spreads between spot prices and physical delivery prices exploded. This tension will worsen. The global energy transition is not reversible. Governments around the world have committed to net zero carbon targets by 2050. Achieving these targets means increasing solar panel production on an unprecedented scale. Each solar panel uses approximately 20 grams of silver. It sounds small, but when multiplied by billions of panels, it becomes massive. Electric vehicles follow the same trajectory. The global fleet is electrifying rapidly. Each electric vehicle uses between 25 and 50 grams of silver, compared to 15 grams in conventional vehicles. With electric vehicle production projected to reach 30 million units annually by 2030, this represents thousands of tons of additional demand. 5G infrastructure adds another layer of constant pressure. Each station requires components containing silver. With millions being installed globally, demand does not stop. Artificial intelligence and computing depend on servers that use silver in critical circuits. All of these technologies need silver. On the supply side, the situation is critical. 70% of silver comes as a byproduct. This creates a structural problem. Production does not respond to price. It depends on the viability of mining lead, zinc, and copper. Even with silver at $100, if copper does not pay, mines do not open. The few existing primary silver mines already operate at maximum capacity. Opening new ones takes 7 to 10 years. There is no quick solution. The industry is trapped, demand growing while supply remains constrained. And here is the crucial moment. When investors and industries realize this reality, the rush for physical metal will be unstoppable. There will be no low price to attract sellers. Silver cannot be printed or digitally manufactured. This is the fear of financial institutions. Not high prices, but loss of control. When millions discover they can own a real, scarce asset outside the banking system, the game changes. Physical silver cannot be inflated, hacked, or frozen. History shows that when populations lose confidence in fiat currency, they run to precious metals. It happened in Weimar, Zimbabwe, Venezuela, and Argentina. It is happening now globally through institutions and sovereign funds. So what should you do with all this information? The answer is clear for those who understand the full picture. Position yourself before physical reality forces a repricing. And that means buying physical silver, not paper contracts, not promises of future delivery, but real metal that you can hold in your hands. The difference is fundamental. When you buy a silver ETF, you own a promise that there is corresponding silver in some vault. When you buy futures contracts, you own the right to demand delivery that will most likely never happen because the system was designed for cash settlement. But when you buy physical coins or bars, you own the real asset. No one can print more. No one can dilute its value through financial leverage. The institutions that are accumulating now know this. They are not buying paper. They are removing physical metal from COMEX vaults, buying production directly from miners, signing long-term supply contracts with refineries. They are positioning themselves in reality, not illusion. The ordinary investor has the same opportunity, just on a smaller scale. Buying physical silver today, during this phase of price suppression, means taking advantage of the last moment in which major players need to keep the illusion alive. They need the price to appear controlled while they accumulate positions. Once they have accumulated enough, there will be no more reason to suppress it. The price will reflect real scarcity. There are important practical considerations. Physical silver has storage and insurance costs. It has a wider bid-ask spread than financial assets. It pays no dividends or interest. But these apparent disadvantages are actually protective features. Assets that do not pay yield cannot be manipulated through interest rates. Physical assets do not disappear in bank failures or liquidity crises. The historical lesson is clear. In times of financial collapse, those who own real assets survive. Those who own only paper assets discover that paper is exactly that, paper. During the 2008 crisis, banks that seemed solid evaporated overnight. Centuries-old institutions failed. But those who held physical gold and silver maintained their purchasing power intact. The same will happen in the next crisis. The difference is that this time silver scarcity is not only monetary, it is industrial. Even if governments try to confiscate precious metals as they did in 1933, they will not be able to confiscate the demand from solar panels, electric vehicles, and digital infrastructure. Modern technology depends on silver in a way that the 1930 economy did not. This creates a unique dynamic. Silver is not just a store of value against monetary inflation. It is a store of value against technological scarcity. It is a double bet: financial protection and exposure to green technology growth. Few assets offer this combination. The window of opportunity will not remain open indefinitely. Each manipulated crash removes more physical metal from the market. Each time, less silver is available for purchase. COMEX inventories have been falling for years. Eventually, there will be no more metal left to withdraw. When that happens, the paper market will collapse and the physical price will surge vertically. Those who wait for confirmation, for validation from traditional media, for approval from mainstream analysts, will arrive too late. When everyone agrees that silver is undervalued, the metal will already have been accumulated by the right hands. The moment to act is when the narrative is still being contested, when the majority still believes in the stability of the system. The great lesson is simple but powerful: in manipulated markets, follow smart money, not the displayed price. Watch what institutions do, not what they say. They buy physical while selling paper. They accumulate real scarcity while creating artificial abundance. This contradictory behavior reveals their true intentions. The investor who understands this dynamic gains a strategic advantage. They do not need insider information or exclusive access. They only need patience to accumulate during suppression and conviction to hold through volatility. The fundamentals have not changed: limited supply, growing demand, structural deficit. The price will eventually reflect these fundamentals. If you understood this story, do not forget to subscribe to the channel, like the video, and leave in the comments which city or country you are watching from. The knowledge shared here can change your financial position in the coming years. Use it wisely.